is Yvonne of FAS Bookkeeping and Tax Services, and welcome to another video brought to you by FAS. In this video, I will be discussing why some companies prosper and some fail. So negative cash flow is the first sign that the company is having problems in their business. Negative cash flow is really not the problem. It's the symptom of a problem. So there are some common causes of negative cash flow. So the first one is poor or no marketing strategy. So in your business, you need to have business objectives, and then those business objectives are translated into financial objectives. And then based on that financial objectives, you come up with a marketing strategy on how you can meet those financial objectives. So for example, your objective is to grow your business, the top line, which is the revenue, 10% year over year over 5 years. Now, to achieve that 10% growth, you need to have a marketing strategy on how you will generate that revenue, and that would include both your pricing strategy and also your volume strategy. So without having any marketing strategy, so that is the first issue there of poor cash flow. So the number two is operational inefficiencies that remain unnoticed until it's too late. Like when the company started having this bounce checks or not being able to pay their bills or pay their employee. And then the third one is poor or no financial reporting system. So if you look at your the revenue cycle or all those transactions that you in generating the revenue, and all those financial transactions as you execute your operational procedures to provide that product or service, those transactions should be summarized and translated into a meaningful format we call the financial information. And without that information, it's really hard to know what is going on in your business, or are you able to achieve your financial objectives and your business objectives. So the financial information is very important for you to really understand what's going on in your business. Now, another way to look at it is so as I've mentioned earlier, there's no clear plan to grow the revenue. It doesn't really know their true product cost. So again, the revenue growth is a combination of both the pricing strategy and your volume strategy. To be able to come up with a good pricing strategy, you need to know what your true product cost is. What is the direct cost you incur in providing that product or service, whether it's materials or labor costs. And if you don't have that, you don't really know how much is the cost when you provide that product or service. When that particular product is out the door, you don't really know what is the true cost. And not knowing what your true cost, it's really hard to determine what's the right pricing for your product or service. So that's why it's very important. And if you don't know that, then, or if you don't really have a good idea of what your true product cost is, then that affects your revenue growth. And then if you're not charging enough to cover your costs, and that's really a function of really knowing what your true product cost is. So the negative cash flow is caused by problems from both the marketing, the operation, and the lack of financial information system to measure your actual performance. Let's talk about the real problem here. So the real problem, one of the problems here is you just don't know the true cost of your product or service. So we've heard this, like, I don't know if we're charging too much or too little. I don't know if we would be better off winning this deal at a lower price or just losing the business. So those are an indication that the company don't really know what their true cost is, and it's a struggle to come up with the right pricing, and it will be a struggle to come up with a good pricing strategy if you don't really know what your true product cost or service cost is. Now, when you talk about financial information system, And that's really important for a healthy cash flow and profitability of your business. So accounting is really, again, summarizing all the transactions, all the financial transactions that occurred in your marketing and in your production. So these three are really the pillars of the business. Whether you're a small company or a large corporation, these are the three fundamental functions that every organization will have. You would have the marketing, which is generating revenue, and production, which is providing that product or service, and then summarizing and translating those transactions into a meaningful format, and that's where the financial information system or accounting system comes in. So let's talk about your product cost. I've been talking about the product cost, the true cost, and what is that really is. So you have to determine your cost of goods sold to make an intelligent decision about the correct pricing for your product or service. So what are those? So direct materials, direct labor. Those are, when we say direct, those are the costs that you can directly identify that you incur in providing that product or service. So if you're, for example, you're in a plumbing business, so your direct materials will be all those parts or materials that you use in providing that plumbing service. And of course, you would have a labor person that's doing the repair, so that would be direct labor. So those costs you can identify on that particular job or particular service. So those are the costs that you have to capture as a cost of goods sold or direct cost rather than part of your operating expense. And you need to have a good accounting system and a good chart of accounts set up correctly to be able to capture that in your accounting system. So when you run the report, it would show how much is your revenue, how much is your cost of goods sold, and this is the gross margin. And is my gross margin enough to cover for my other operating expenses? And after I subtract or pay all my cost of goods sold and all my operating expenses, is there still money left for me? Is there like a profit after? So that is a very important information that you should be able to get from your financial information, like your profit and loss. So another concept that I want to introduce here is really understanding what the fixed costs and variable costs are. So the fixed costs are really those costs that you incur regardless if you generated revenue or not. So a good example will be rent, utilities, regardless if you have billed a job for that month, you still have to pay your rent on a monthly basis. So those are fixed costs. The variable cost, that includes your direct cost, your cost of goods sold, as we discussed earlier. So that would be your materials and direct labor costs. Now the indirect cost or cost, so there's also variable cost that not necessarily a direct cost, and we call that indirect cost because you can't really directly identify this expense as part of providing the service or the product. So a good example would be advertising expense, marketing expense. So those are all still a variable cost because you don't really incur them every month on a fixed amount on a monthly basis, but you incur that if you decide that you want to invest or spend money on marketing or advertising, but that not necessarily attributed to providing the product or service. So it's very important to really understand the fixed cost and the variable cost, and I'll again in the next couple of slides I'll explain why. So break-even point means that it's the point where you're not incurring profit or a loss. So that's your break-even, no profit, no loss. But of course, you don't really want to be just trying to target a break even. You want to have like a profit over time, right? Maybe in the first year, the objective is at least to break even, but after your first year, then your financial goal should be making a profit over time. So how does it look like here? So just to explain this chart here, so your revenue, of course, you want that to be growing over time, right? And then the way the variable cost works is it behaves in the same manner as the revenue. So if your revenue is increasing, your variable cost is also increasing to some extent, right? So for example, again, going back to the example of the plumbing service. So the higher your revenue is, the higher your materials and supplies, because you have to use that when you're providing the service. And your labor cost will also be increasing if you and your labor cost will be increasing because the more jobs and the more people you need to hire to provide that service. So it behaves kind of in the same manner to certain extent to the revenue. So you see here the revenue is increasing and the variable cost is increasing as well. Now the fixed cost, so we said it's more like fixed amount every month regardless if you generated a revenue or not. So that's why the behavior, like the way it behaves, it's just fixed over time, right? Now your total cost would be your variable, the total of your variable and fixed costs. And this is the part where you're breaking even, right? So that means you have this revenue and you have all this total cost, and you're not incurring any profit or loss at this point. But again, you don't want to be just targeting a break even. Over time, you want to make a profit. So that is the main concept that I want to explain here. So that's a break-even point. So when we talk about all those inefficiencies, we need to really look closely at your cost of goods sold and your operating expenses. Let's try to analyze the cost of goods sold and overhead, or that will be more your fixed cost versus your revenue. And so when you analyze it, you can tell if there's some unhealthy trend that's happening there, and you can, look at it more on what's causing the inefficiencies, or how you can better manage your costs. So here, analyzing cost of goods sold and overhead trend versus revenue. So we're saying this is a healthy trend. So why? So your revenue is going up, so that's a good trend. Your cost of goods sold is going down. As I mentioned earlier on previous slide, the cost of goods sold is a variable cost, and it behaves in the same way as the revenue to a certain extent. So what this is telling me why it's going down is they become more efficient in managing their materials and labor costs. So for example, on the materials, they're probably able to get a higher discount or a volume discount, so that reduced their cost of materials. On the labor cost, it went down probably because their people are more efficient, their workers are more efficient, they've achieved that learning curve, and now they're really performing the job well, very efficiently, and so that they're able to do more in less time, and that would affect the cost of goods sold. It would reduce the cost of goods sold. And then overhead, as we said, those are fixed costs, so it just kind of flat over time. If you can review your fixed expenses and identify those that you can, if you can look at your fixed expenses and there are some expenses there that you think you don't really need Like for example, there's some subscription that is just there, you're paying it every month, but you don't really need it, and you never use it or you seldom use it. So that's one opportunity for you to look at. Now here we're saying it's unhealthy trend. So why is that? Well, the revenue, the expense is growing faster than revenue, so eventually that would result to a negative cash flow and a net loss for the business, because expenses or outflow is more than the inflow, the revenue. Well, this is another unhealthy, because of course the revenue is going down, so that's not good, right? And this one, the revenue is growing, but the expense is growing in the same trend as the revenue. So remember, expense here, that includes both the cost of goods sold, the variable cost, and the fixed cost. So there should not be a direct trend here in terms of revenue and expense. So the expense should be a little bit lower in terms of the growth there, because of the fixed expense there. So bottom line is, we need to closely monitor our operating expenses. Let's look at managing cash inflow. So that's the revenue side here. So there's some short inefficiencies that go unnoticed. So overspending or uncontrolled operating costs. So that's something that you need to look at on a monthly basis. And a tool that you can use is, if you run a P&L, like a monthly P&L, you would see the trend there in terms of the different cost and expense category, and that would trigger you to look into which expenses or costs are you spending the most, and is there a way you can reduce those costs. Uncollected or past due receivables, you don't want to be financing the business of your customer, so you want to make sure that you're running that aging of receivable on a regular basis, if not weekly, at least monthly, so you can see all those aged receivables and you can start following up with your customers. Poor inventory management, and then of course high financing costs. That's more like the effect already, right? So if you're having cash flow issue, you try to borrow more, so you increase your loans, and therefore you also increase your financing costs or the interest expense that you're paying to your lender. So let's talk about receivables. If you're a company that's offering terms to your customer, there's a couple of things that you can do to manage your receivables. You don't just expect prompt payments. You have to there's some work involved there. So of course you have to understand the paperwork, like you make sure that you bill your customer on time, and then you collect on time. If you're not able to collect on time, then you follow up with them, and that's really the aging of receivable can help you a lot in terms of monitoring those past due receivables. Prepare a cash flow forecast, and that would really help you in terms of knowing how much is your revenue each month, how much is your expenses. So on the 6th month, you know you'll be a negative cash flow, so you can start looking into some options in terms of getting a line of credit, or other things that you can do to be able to fund those negative cash flow in this next 6 months. So that's really the benefit of having a cash flow projection. Invest in your bookkeeping or accounting system and support. If this is something that you don't really want to do, you're better off, in your mind, you want to spend your precious time with your customers and generating more revenue, establishing good relationship and keeping those customers, then invest in a firm that you know can really help you with your bookkeeping accounting system and provide you with those timely financial information. Investigate the root cause of the collection problem. So it can be just really customers that just dragging the payment, or you're not billing on time. So those are the things that you can look at and make sure you resolve those issues. Of course, you need to utilize technology. You don't really want to be preparing an invoice on like just a paper invoice. There's a lot of technology and accounting software out there that you can use to automate some of this invoicing and billing function. And if you don't really know how, seek help. Now, establishing a good financial information and monitoring system will help you in measuring your actual performance. So in your business, as I started in this video, you would have business objectives, financial objectives, and then that would be more of your basis for like really determining if you're able to achieve your financial objectives. With your business objectives, you have the financial objectives, and then on a monthly basis you track your performance and compare that with your objectives, and that will tell you if you're actually achieving your financial objectives. And if you're not, then go back to the drawing board and see what else you can do to make sure that you achieve what you have set for your business for the year or for the next 5 years. So again, I can't emphasize this enough. Review AR aging weekly at the minimum on a monthly basis. Review your financial reports monthly. If you're not getting that monthly from your bookkeeper or accountant, then ask for it. Once you have that, you have to review and really look at it on a monthly basis. The thing is, business owners are really not comfortable with that financial reports. But what I can say is, if you look at your financial information on a monthly basis, you get more familiar with it over time, you get more comfortable, and then you start to see what doesn't make sense, and you can start asking questions to your bookkeeper or your accountant. It takes time, but again, if you just have that regular review of your financials, you get more comfortable with it, and you can see what don't make sense as you look at your financials. So review inventory. If you have inventory, identify the fast moving, slow moving, non-moving, and then make the necessary action. And again, invest in good technology. For some operating performance, there are some ratios that we can use in our business as key performance indicators. So key performance indicators are those that it's like a scorecard. That's how you measure your success. So an example earlier is like the 10% revenue growth year by year, right? So that's your key performance indicator. So if you look at your financials year by year and you're only achieving say 5% instead of 10%, then that would trigger you to look further and see what else you can do to grow your revenue, what else you can do, whether it's on the pricing or on the volume. But that's one of the key performance indicators that really is very useful for your business. Of course, profitability ratio, activity efficiency ratio, those are your days sales outstanding, which is the age of your receivable, your inventory turnover. Some of the financial condition measures here would be your liquidity ratio, and that would be your current ratio or acid test ratio, and then your leverage ratio. So those are some of the ratios that you can establish as key performance indicators for your business. And mind you, these are also the ratios that the lender calculate whenever they are reviewing the loan application of a business. So it makes sense to be familiar with this, and you're more like ahead of the lender. So that would tell you if there's like a standard for current ratio and your business current ratio is this, then you can tell if you need to do more in terms of achieving that. Let's just say 1.5 to 2 current ratio in order to get the approval for that loan application. So cash flow is really critical. It's really more of like planning for the next 6 months or 12 months, so you know your financial or cash flow position, whether you're a negative or positive cash flow. And with that information that you have ahead of time, then you can take action before the checks start bouncing or you're unable to pay your bills. So when you're preparing your cash forecast, you're on the side of caution. Of course, account for the time lag. So for example, if you provide terms to your customers, so and your term is 20 or 30 days, then you have to account for when you will be collecting that, from the time that you invoice up to the time that you collect. So that's what that means for accounting for the time lag. Of course, don't overlook smaller items. It can add up and may still affect your cash flow, so don't overlook those. Of course, you want to look into the best and worst case scenario. What does it look like on the best case, and then what does it look like on the worst case scenario? And lastly, factor in seasonality. And I want to end here with meeting regularly with your bookkeeper or accountant to discuss the financial health of your business is really critical. This is a service that your accountant or bookkeeper should be providing to you as you need it, because this is really helping you to understand the business. So meet regularly with your accountant or bookkeeper to discuss your company's financial results. Use this as an opportunity to ask questions or brainstorm on what else you can do to better manage your costs, or evaluate your direct costs, so you can use that better for your pricing strategy. And allow this meeting as also a brainstorming opportunity for both of you to come up with some insights or ideas on how you can better grow your business. So again, this is Christy Fontanilla, and I'll see you next time.